Texas Roadhouse Stock, ticker symbol TXRH. This stock is up 2% year to date, underperforming the S&P 500 big time. The stock is also near their 52-week low of $90 right now. It has come down quite a lot from near their all-time high. On the 27th of July, Texas Roadhouse presented quarter results where they beat on EPS and revenue. For the upcoming earnings, almost all analysts think they will miss the estimates. And people love TXRH stock because of multiple reasons, and one of them being the dividend. And I understand why, with dividend yield at 2% and a 17% 5-year compound annual growth rate. So could this be the perfect moment to buy TXRH stock? Well, I'm very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So what does TXRH do? Texas Roadhouse is a restaurant company operating in the casual dining segment. The company's operating segment includes Texas Roadhouse, Bubba's 33s and others. And if we dive in the most recent earnings report, we see that revenue was reported at $1.17 billion. Up 14.3% year over year. This looks really good to me. Income from operations is up 11.1%, so it's slightly lower than the revenue. But net income was up 13.6% year over year, so this looks good to me. Earnings per share were reported at $1.22, up 14.7% year over year. Again, looking really good. It is very easy for Texas Roadhouse to increase revenue by just opening a new restaurant. But you also want them to increase the comparable restaurants. Texas Roadhouse reported a comparable sale increase of 9.1%, which is looking really good to me. Next to that, there were 3 company restaurant openings and also 3 franchise openings. For the full year of 2023, Texas Roadhouse expects to report a comparable sale at 10.7%, which is an insane number, and also slightly higher than the current number. Another interesting thing is that they plan to open 28 new restaurants, which is a great number in my opinion. This will add a lot of revenue for the future. And a thing to keep your eye on is the decreasing restaurant margin. In this recent quarter, it did increase from 16.6 to 15.7%, so that's something that I don't like. And now that we know a little bit more about the company, it is time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analysis every week, and also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. Texas Roadhouse is a $6.39 billion market cap company. PE ratio is at 22, which could indicate that they are undervalued right now. Later in this video I will show you my 3 price targets for TXRH stock, so make sure to watch until the end, because PE ratio is only telling a small part of the full story here. Revenue is at $4.3 billion, and in this graph we see that revenue went up in the long run. During the lockdown periods, revenue went down a bit, which makes a lot of sense of course. The same event is also reflected in the margins. It was pretty steady level, but during the lockdown periods it took a nosedive. The good thing is that it recovered rather quickly. EPS is following the same pattern as the margin and the revenue. Nothing really special to add here. Analysts expect that in 2023 the EPS will grow at a pretty high number, from 13 up to 17%, so this looks really good to me. For the revenue it is a pretty similar story, but with slightly lower numbers. It's expected to slow down a bit over the years, which also makes sense, but still looking good to me. Return on assets is sitting at 8.1%, which is a decent number. Return on equity looks also very good, and the most important number, return on invested capital, is sitting at 11.9%, which is a great number. And it is slightly higher versus the 5-year average, which is also something that I do like. Current ratio is at 0.41, which is looking pretty good. There is nothing really special to mention here. Right now TXRH has $739 million in debt. and I prefer companies that can pay down at least a big chunk of the total debt with their total cash. TXRH has 100 million in total cash, so they can't pay down a big chunk of their total debt. This is something that worries me a bit. But keep in mind, during lockdown periods, companies like TXRH did issue a lot of new debt to survive. So it's very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And here we see that free cash flow is going up pretty steady and consistent. Again, we see the impact of the lockdown periods. Shares outstanding are decreasing, which is something that I really like. When shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at 2.33%, which is a great number. Annual payout is at $2.2 and payout ratio is at 46%. I prefer 50% or lower, so right now they have 54% left in cash to buy back shares, pay down debt, do acquisitions and all other things. The 5-year growth rate is at 17%, which is a great number, and they have no consecutive years of dividend increases. And if you take a look at these numbers, the dividends paid since 2012, you see that TXRH did increase the dividends at a double-digit rate for a long time. But during lockdown periods they cut the dividend, which was a smart move in my opinion. Payout ratio is a very important metric with dividends. It tells you if the dividends are safe. In here we see that over a longer period of time, payout ratio is kinda steady at 50%. In this graph we see the expected dividends in 2023, 2024 and 2025. Of course this is an estimation and can be highly impacted by results, but it gives you a rough indication. It's expected to grow at similar growth numbers, which is very nice. Overall these dividends look pretty good to me, but how about the historical returns? I decided to compare TXRH stock with the overall market, in this case the S&P 500. Next to that I added some competitors. On the 5-year chart we see that TXRH was beaten by the S&P 500. In total TXRH returned 49% including dividends, versus the S&P 500 sitting at nearly 70%. Wingstop had the highest return with 180%. On the 1-year chart we see that the S&P 500 again did beat TXRH, and also Wingstop has again the highest return here. On the 6-month chart it is looking pretty different, with again the S&P 500 having the highest return, but with TXRH and Dutch Bros having the lowest return. Even Wingstop is at a negative number. On the 1-month chart it is again TXRH sitting at a negative number. Both Wingstop and Dutch Bros managed to get a positive return and beat the others in this list. So bottom line, TXRH stock was beaten by the S&P 500 in the long run and most recently. It is also not looking any good. So could this be the perfect moment to buy TXRH stock? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with the revenue growth. For the revenue growth I'm filling in 8, 10 and 12% based on historical performance, their own outlook, but also because of the analysis. For the profit margin I'm filling in 6, 6.5 and 7%, and for the free cash flow margin I'm putting in slightly lower numbers. For the PE ratio and the price to free cash flow I'm putting in 20, 22 and 24. It is a company in a niche segment and they are capable of growing at high numbers both in revenue and comparable sales. My desired annual return is 12.5% since I can get an easy 10% average annual return with owning an ETF. Right now TXRH stock is at $95. I hit analyze and we see a lot of green numbers. We have a low price target of $66 to $80. We have a mid price target of $91 to $107 and we have a high price target of $123 to $143. To me, the mid to high price target is the most justified here, indicating that this stock is undervalued right now. My final conclusion on this stock is that I love the company and the stock. It is currently one of my smaller positions, but with the stock price decreasing rapidly and the business itself improving, I'm going to buy a whole lot more shares anytime soon. Most fundamentals look really good and they are capable of growing at high rates. The dividends also look really good as they are capable of grow them alongside with the other numbers. And the last thing, the valuation also looks really good to me. In my opinion, they are undervalued and I can't wait to buy more shares. But remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.